Corporate Finance Presentation, Capital Budgeting Risk Overview. Get ready, it's time to take your chance with corporate finance. As we think about risk, we're going to look into statistical type of tools to analyze the risk with relation to capital budgeting and investment decision. Quick recap of the capital budgeting decisions. Those are those long-term type of decisions, usually involving us putting money down up front in order to get future returns, those returns usually affecting multiple periods in the future, and therefore we need time value of money calculations, typically to assess those types of decisions. Those tools for the time value of money being the net present value calculation and the internal rate of return. If you want more detail on those calculations, take a look at the prior section where we go to them in detail. You'll note, however, that when we think about these net present value and internal rate of return types of calculations, we have to assume that we have determined what the future cash flows will be so that we can do the present value calculation. Obviously, we're talking about something that's going to happen in the future. We don't know what the cash flows could be. All we can do is make our best guess. So now we want to think about how to make the best guess, and possibly some projects we can assume to be more risky than other projects, and the projects that are more risk, how do we deal with that with regards to our decision-making process? How do we compare one project that has more risk but possibly a higher return versus another project that has less risk if we can only put our money into one or the other of them? So risk, what is risk? The variability of future outcomes from an investment. So we have an investment, we're projecting what's going to happen in the future. We're going to try to put our assessment on the risk, the likelihood of one outcome versus another outcome happening. We don't know what's going to happen in the future, but we can clearly look at where we're at now and try to assess how risky one decision would be versus another, and then tailor our decision-making process to take that into consideration. Measures uncertainty in the decision. When we think about the likelihood of something happening in the future, we can think about the average or what we expect the expected value to be, and then the spread of the data. How likely is that expected value to be? And we can then plot out the likelihood that we do not think it's going to happen. The more spread out the data, then the more risk that you would generally consider to be apparent. So for example, if we look at this first option where we have three outcomes that we think possibly could happen, we're going to say A, B, and C, and possibly A's $1,000 return, B $2,000, and $3,000. B is going to be the one that we think is more likely to happen. We would call that kind of the average or the expected return with regards to our analysis. Then the question is, well, how likely is it that B will actually take place? It's at the 50% here, and then we have the 25 for A and 25 for C. This is a less spread out data set than we might see if we were having our analysis look something like this, where the mean or center point is at 30%, and then we have more in the outer reaches here. This then would indicate in general that we have less likelihood that the mean or average will happen. We still believe the expected value will be at this center point, but there's a more spread out amount of data. Therefore, the likelihood of it not being at that center point increases, and that's going to generally increase risk, which is generally something that we would try to reduce. And of course, down here, we now have the center point mean or average or the expected value at the 25%. Once again, risk has been spread out. There's more likelihood that it will not be at that center point, which increases the risk. Now, note when you look at actual data, and we run like models on this, right here we're looking at a bell-shaped type of curve to see if the data points would fit into the standard deviations. We could start to talk about, the standard deviations, how likely the point will be at the middle point. However, if you start looking at the actual data set and you see that it's skewed to the right, meaning if the first one was going to be giving you $1,000, $2,000, $3,000, $4,000, $5,000, $6,000, $7,000, the items to the right here would actually be away from the mean. They would be an outcome that's not at the center point, but they would be beneficial, right? Those would be added money, as opposed to if the outcome was going to be on the left, then of course those would be less than what we would expect, and that would be a bad outcome. So generally what we're going to take a look at is basically think about the data points. Where is it going to fit in a standard deviation type of analysis? And usually the more spread out the data, the worse it's going to be. because that's more likely that there's going to be risk. However, again, you want to look at the actual data points as well to consider, what the spread of the actual data points would be, and that could affect your decision-making process as well. So that's going to be the general process. We'll start to talk about some of these statistical terms to organize our thoughts as we think about the future. Obviously, again, we don't know what's going to happen in the future. Everything that we're projecting into the future is projected, given it's something in the future. But this is a way that we can start to organize our thoughts so that we can make as best a decision as we can. So risk averse, and the general rule for investments is usually making managerial decisions. We're going to be somewhat risk averse, meaning we're going to avoid risk unless expected return is high enough to make up for it. In other words, there's two things that we're typically considering with regards to our projects in the future. One is what we concentrated on in prior presentations, which is going to be the return. Is the return enough, the expected return that we think we're going to get, enough to warrant the risk that we're taking on? If we have a higher level of risk that's going to be happening, then we have to have an expected return that's going to be enough to warrant the increase in the risk. And that leads us to believe, basically, as the risk level goes up, then people start to think that if risk level is higher, then the expected return is higher. That's not necessarily the case. As your expected return goes up, it's often the case that risk goes up. So when you're looking at projects that have a higher expected return, oftentimes there's going to be more risk involved in those particular points of projects. But it's quite possible to have risk go up without the expected return going up. And those are typically the projects that we want to avoid, meaning the risk going up is not the thing that drives the expected return to go up necessarily. Risk can go up without the expected return going up. If the expected return is going up, then oftentimes that does come along with risk that will go up. And those are the areas that we need to basically focus in on and decide, is that risk going to be something that we want to take on with regards to the individual project? And we can also think about risk levels as they relate to us as a company as a whole as well. When we measure the risk involved with a particular type of project, does that fit well with our risk assessment as we think about our whole holdings, our whole asset base, our whole investment portfolio?